LBR LBO Debrief Business Climate Outlook of 2016.
So Ralph expanded on some of the areas that Dr. Ikeri mentioned, particularly rebalancing of Chinese economy, as well as possible impact of normalization of US economy on our capital market, our interest rates, etc. What is also important is TPP. Okay. Unfortunately, there's a section in our industry, a section in our bureaucracy, and there's a section in our professional bodies who are against any form of, bilateral or multilateral trade agreements. Trade agreements means, oh, that's bad for us. There will be Indian diploma holders who will come here and, perform surgeries, brain surgeries. So that's our GMO is fear. So whether we like it or not, countries are getting together into trade blocks, investment blocks, closer and, more integrated. Closely integrating their economies. So TPP, is it an opportunity or a threat? Okay, there are some of our friends, colleagues from apparel industry mentioned about the threat. If TPP becomes reality, what will be the impact on our apparel industries? So very interesting, observations. Some are opportunities, some are threats for us to think about. Our next presentation is, our next speaker is from IFC. She's based in Mumbai, and she is going to help us to understand India and developing Asia. As I mentioned earlier, we haven't paid much attention to developing Asia in the past, but we know that some of our companies, some of our banks are looking at countries like Cambodia, Vietnam, Myanmar, and of course, some of our companies, logistics companies and apparel manufacturers, set up factories in Bangladesh. So it is important that while we are paying attention to what is happening in the key markets in the world, markets which are important traditionally to us, okay, what are the opportunities that we can reap? What are the benefits we can reap by having closer relations, closer economic trade and investment relations with emerging developing Asia? Ladies and gentlemen, it is my pleasure to present to you IFC senior economist, Gunjan Gulati, who will enlighten us on outlook and the state of play of India and emerging developing Asian markets.
LBR LBO Debrief Business Climate Outlook of 2016.
Hi, good morning everybody. Before I start with my presentation, let me take a moment to mention how I could not agree more with what Mr. Lakshman alluded to earlier in his debrief today about the relevance and the need to probably for the region to look inwards, and especially in the current time when there are cyclical and structural changes happening in the developed markets and in some of the bigger emerging markets. I think it is relevant for the region to look inwards in terms of identifying how the linkages within and outside the region are changing, and how it needs to reevaluate the drivers of growth. And I'm glad that the organizers decided to introduce this session this time around. And let me take this opportunity to thank the organizers for reaching out to me and inviting me for taking this session. With that, let me start with my presentation. Given the vast number of countries I'm going to cover in this session, what I have decided is, what I have done is try to call out key themes which govern these countries and broadly talk about those, and then we can discuss about specific countries if required. So key themes which come out in the region in the last 1.5 to 2 years, as what I call it the 4D challenge, largely governed by highly leveraged corporate sector, the debt, weakness in demand, some parts of deflation, but largely in the producer prices, and the depreciation of the currencies across the region. Given that we saw a sharp correction in the commodity prices and oil prices, which basically meant higher disposable income, we did not see a significant improvement in the demand in these countries, and this was and there was no consequent increase in the consumption, be it retail sales, car sales, housing spending, and consequently we see a weakness even in the manufacturing sector. What basically now, if we see some of the countries are exhibiting some consolidation with respect to production and consumption. You can see in the chart on your right, this, I'm trying to capture the consumption at the retail level by car sales. Countries like Indonesia, Thailand continue to be contracting, while some of the high-frequency indicators for India and Indonesia suggest that there is some sort of consolidation, but we are not sure whether these countries have reached the bottom as yet or not. The other demand indicators, investment, continues to be the weakest link. Investment largely led by the private sector because of low weak demand and lower capacity utilization and high level of interest rates in the economies. It kind of constrained the private sector to take fresh investments. You can see that in the bottom left chart where the fixed capital formation for the region as a whole, which is represented by the dotted line, it's been contracting. Though across the countries, it's again a mixed trend. But again, for countries like India, we're seeing some kind of stabilization and pickup. But largely across the region, the stabilization is coming from public sector and not private sector. If we look at the top right chart, it basically tells you how the forward-looking sentiment is, which is the PMI new orders. For most of the economies, it is slightly above the 50 mark of expansion, but countries like Thailand and Indonesia, it still remains below 50 mark, suggesting that the sentiment still remains weak with respect to the private sector. Demand for Asian exports. Exports continues to be the biggest drag on the growth story of the region. We know for almost like last 10 to 15 odd months, exports have been contracting on a year-on-year basis for most of the countries. And this is, we know the region per se has been a provider of intermediate goods to China, which used to process it and further export it to developed markets. Now with the sharp slowdown in the Chinese economy, that component of demand for Asian exports took a big hit. But apart from the cyclical demand in China, there was also a structural story panning out, which as we heard in the previous two presentation, is the transitioning of Chinese economy from an investment-led growth model to a consumption-led growth model. And hence, the whole commodity composition of Chinese imports is now shifting away from what it traditionally used to be. And apart from the growth slowdown and the China story, one thing I quickly need to mention here is the increased linkage between the Asian trade, which is the intra-Asia trade model, is highly, is quite significant here. If you look at the table on the bottom right, it tells you how each of these countries are dependent on each other. If you exclude the China and the Japan trade, you will see countries like Malaysia and Thailand are highly dependent on the Asia trade, which basically means that even if there is the China story, the China demand is taken out, the impact of lower income in these economies is further affecting the demand for regional exports. So there is a spillover effect which is happening because of lower economic activity in these countries. So thus the intra-region story kind of takes more significance in the current time. Moving to the second D, the debt. We have seen since the post-global financial crisis a significant ramp up in the overall debt to GDP ratios of most of the Asian economies. This was largely led by private sector borrowing from the banking sector to undertake fresh investments, but following lower demand within economies and now in the external world led to lower capacity utilization and excess capacity in these countries and higher debt situation and higher NPLs in some of the countries like India and China. This is obviously translated into weaker credit growth, which is reflected in the chart on the bottom right. Sri Lanka clearly being one of the outliers, which is still witnessing high credit growth. But otherwise, we see moderation in demand for fresh credit and demand for new investments because the private sector remains highly leveraged. And also the banking sector per se is kind of cautious to undertake new investments, given that either because they are cautious of on-lending to infrastructure utilities, or they want to or they're not seeing fresh demands from the market. Moving on to the depreciation, since the time of expectations of Fed undertaking policy hikes, we have seen a rapid deterioration in the exchange rate of most of the countries. Since the mid of this calendar year, there has been some sort of consolidation, which you can see flattening of the exchange rates in some of these economies. Central banks, most of the central banks have been managing and trying to intervene, but there have not been significant intervention. I mean, it's expensive, A, to manage the currency, and B, also some of the economies, it's helping the currencies to gradually depreciate as it kind of helps them build their competitiveness in the weaker external demand scenario. The chart on the right tells you the months of import cover of these economies. What it also tells us is that in times of volatility, if going forward, if we see some extreme volatility when the Fed undertakes hike, some of the central banks are well equipped to intervene and manage the currency if required. Philippines, India have a decent amount of forex reserves to be able to intervene as and when required to at least manage the extreme volatilities if not anything else. Deflation, we have seen because of the lower commodity prices, the producer prices contracting significantly. If you see the chart on your left, it tells you that China has seen for 44 consecutive months deflation, and by deflation I mean, is somebody's phone here? Not good. Okay. And by deflation I mean the negative print on PPI. So it's basically telling you that even though producer prices have been registering a negative print, if you look at the core inflation, which removes the effect of commodities, the prices remain on a positive level. So we should not expect a deflationary-led spiral in these economies. After this, what we have seen is, given that there has been no private sector-led investment happening, policymakers have been stepping up, either by way of fiscal or monetary easing. Countries like India, China, Thailand, Sri Lanka have undertaken policy rate cuts. Some of the economies which have fiscal space, thanks to the contraction in the oil prices, have also undertaken fiscal expansion, largely through public infrastructure projects. But there is, again, there is a risk with respect to how much of fiscal expansion or monetary expansion the public sector can undertake. We will definitely need to see the private sector being crowded in over the next 1.5 to 2 years, because most of the economies do not have the ammunition to undertake this for the next year, to undertake this in the next year. This is a very interesting chart. It tells you how this region offers a mix of growth options. If you look at the chart on the left, it shows you how the FDI inflows for some of the economies remain positive, while for the other half, they were kind of contracting. And if you look at this chart for other regions, I mean LAC and MENA, you would see all red, or most of the countries in red. What it tells us is that this region still offers growth pockets, and there are some of the economies which are probably not doing well, but you still have pockets of growth which investors can look at. Quickly going through this, it basically captures the expectations of growth collected by the consensus. In countries like Indonesia, Malaysia, Philippines are seeing a downward revision in their growth expectations, while frontier economies like Vietnam, Bangladesh, Sri Lanka are kind of holding up with respect to, and maintaining their 6.5% growth expectations. Outlook for the region is, even though this is the region with the highest growth across the world, and the region needs to take a stock inward with respect to identifying new growth triggers. It has largely been a trade-driven growth model, but now there is a need to diversify towards either new exports or new markets. And within countries, and especially some of the countries have already initiated that, is to undertake reforms, structural reforms which will help sustain growth over a medium term. With that, I'll quickly move on to a relatively deeper dive on India. India has been one of the economies, one of the largest emerging market economies with a favorable growth inflation mix. This tells you how that despite some recent consolidation in growth expectations, growth is expected to remain around 7.5%. Inflation has moderated not just thanks to the correction in global commodity prices, but also because of efforts of policymakers to either, offer support prices which are lower than expected. So this has helped kind of moderate overall inflation and in the economy. India has remained historically a twin deficit economy with fiscal balance and external balance remaining in deficit for the longest time. But consolidated efforts by the policymakers, especially on the fiscal side, and the benefit of lower oil prices has helped lower these two deficits significantly. But again, there are some risks going on. Though we expect oil prices to remain at subdued and muted level, improvement in economic activity will definitely increase the demand for imports, which could exert pressure on the current account. On the fiscal side, there are challenges from government meeting the privatization targets, revenue targets. There is an impending pay commission next year, which could have a significant impact. And also, if reforms don't undertake going ahead in the economy, we may see some downside to the revenue expectations, which can have a negative impact on the fiscal side. Having said that, even though the recent high-frequency data tells us that there's some sort of consolidation on the macro numbers, the pace of economic recovery remains slow. On the consumption side, on the investment side, you can see even though the number of projects which were stalled because of policy inaction has come down, the new investment activity remains muted, which is reflecting in nearly 50 or just about 50 expansion numbers on the PMI. On the consumption side, the story is mixed. The urban consumption is taking benefit of lower interest rates and lower EMIs, and hence the demand for discretionary spending like vehicle sales is starting to look up. But on the rural side, poor agricultural output and weak monsoons and sluggish wages is keeping the rural activity still muted. External demand, as I said, continues to be a drag on the region and on India. It is also affecting the domestic industrial production, not just oil-related activity, but we've seen the impact of the overall weakness in aggregate demand on manufacturing and other exports also. This is again largely led by the fact that the domestic corporate sector have been highly leveraged, and this is largely predominantly in the utilities and infrastructure space. The banking sector, especially the public sector banks, which were exposed to these utilities and infrastructure projects, are sitting on high NPLs. So there is kind of a gridlock situation in the country whereby no fresh investments are taking place, either because the private sector is too leveraged, and also because the banking cannot on-lend to any new fresh investment. This is something which is dear to a lot of people with respect to what's going on in the country, on what the initiatives the government has been undertaking. On the left, I've tried to tell you what the positive steps the government has undertaken, and this is basically lowering the number of approvals which are required to set up a new industry, or overhauling the bureaucracy, bringing down corruption. And this has been, even though these are very small incremental measures, it's improving the ease of doing business in the economy, though it's not resulting in significantly in the pace of economic activity. These will, over the medium and a longer term, be very meaningful for the economy. Liberalizing FDI, increasing allocation for railways and roads, regulating fuel subsidies, inflation targeting mechanism, and push on financial inclusions have been some of the very significant reforms which the government has undertaken in the recent past. However, as I said, there has been no meaningful pickup in the economic activity on the ground. We have also we haven't seen delivery of big expected reforms like land acquisition and goods and service tax. There is still some amount of uncertainty around the tax-related issues in the country. One of the bigger challenges remains the political opposition, which is becoming quite strong, especially after the recent state election and the loss of state elections by the ruling party, BJP. So the key risk right now going ahead is as there are a couple of more state elections coming up early this year and next year, if the government is not able to win those, it probably may end up in not gaining significant majority in the upper house, which could be significantly negative for the government to undertake key policy reforms like the GST and the land acquisition. In that scenario, it probably will have to make do with undertaking reforms like liberalizing FDI rules, which do not require parliamentary approval. Quickly on the markets, it tells you how, despite the overall pain in the global markets, India has managed holding decently well. EM equities 2014 and 15 performance, India has managed with reasonable amount of pain, but it's still holding up better than most of the emerging markets and within the region. Even for currencies performance, there was sharp depreciation in 2014, but this year it's been holding up well. But and the policy makers are cautiously monitoring the global developments and have the ammunition, at least in the near term, to manage any global external shocks. With that, I'll wrap up the India discussion by saying what we need to look out for. Definitely the pace of reform delivery. We have seen government undertaking small, piecemeal, incremental and meaningful reforms, but the investors' disenchantment with the pace of economic activity on the ground is growing by the day, and that's also reflecting in the political outcomes. We need to see private sector being crowded in, and the politics. I mean, we will be closely monitoring how the state elections and how the government manages in the next 6 months.
LBR LBO Debrief, Business Climate Outlook of 2016.